Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Wednesday, August 16, 2017. We're looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. And today, it was pretty predictable that we did get up to the 247.25. We got slightly higher. I think we went up about a quarter more than that. 247.57 on high today. We backed off that number and the market pretty much settled out up almost 0.2%. The SPDR was up 42 cents. And basically what we're going to do from here is let the clock run out on options expiration week. It won't be out of the ordinary and it's not necessarily a high probability, but I won't be surprised if we go up either tomorrow and or into Friday with slightly higher prices. Where are those higher prices? They could take a run up towards $248 on the SPDR, maybe short of that, maybe 247.75 in that neighborhood. If they do that, it's gonna look like the market's gonna make new highs while it's happening, but while intraday that can happen, it's unlikely. It's possible, but it's unlikely that the market closes above the high from the 8th of August, which was last week. If they do, by chance, somehow, close above that high, then it would be in the cards that the S&P 500 is going probably north of, but at least to, 2,500. Right now, the S&P cash index is at 2468. The S&P futures, the ES futures contract is at 2467 and change. As we speak, it's still trading. And the SPY would go up in the $250 neighborhood. So there could be another 30 handles on the upside from where we are now, or even 40 from where we are now, if we closed above the high from the 8th of August. Again, unlikely, but anything is possible. And if that did happen, it would certainly bring the cycle into question. I'm not saying that it's off the table, but it would certainly bring it into question. We'll see what happens. I'm not expecting a close up in that neighborhood, but I just wanted to bring it to the forefront because with the market, anything is possible. Cycles do fail. It's happened before. It will happen again. I just go with it until or unless it fails. And right now, it's still active. It has not failed. And the top is in until proven otherwise, and that would only be a close above the high from the 8th of August. And in my book, technically speaking, you really need a secondary close above that level to really solidify the close above that level. So it could be a one-day wonder if we got up there, but I'm not counting on any of that. I'm just bringing it to the forefront because anything is possible. Let's talk about the cycle for a brief minute. And let's just look and identify with what happened over the last couple of weeks as the cycle. We said originally that the cycle was due to top out, or the cycle was due to culminate anywhere between the middle of July into the first or second week of August. Okay, so here we are. Now, we've had basically a number of things take place, and I think there's more to come. But think about what happened as I'm talking about a culmination of a cycle. All of a sudden, North Korea becomes an issue. They've been threatening the U.S. for 50 years. They've been firing missiles for months, and years for that matter, but they've really accelerated the process. And all of a sudden, it becomes front page story in the news. And last week, everybody's concerned with North Korea to the nth degree, and the week before that. So that, in my mind, tells me that the cycle is taking hold. All of a sudden this week, nobody's talking about North Korea. Now we have the issue in Charlottesville that took place. We have some civil unrest. I'm not going to get into the banter back and forth of who's responsible and what's going on, but what you are seeing is civil unrest, and it's not the first time, and I think there's more to come. All these type of things coincide with the type of environment we can expect when a cycle culmination is due. We also have one more thing that happened today, which I find interesting to say the least, which is essentially the collapse of the President's Economic Council on manufacturing, I believe it was. And I don't know all the details, but what I do know is that it shows an interesting disrespect, in my mind, for the office of the president. Whether you like Donald Trump or you don't like Donald Trump doesn't really matter. These are unprecedented times, and we're seeing things that are uncommon and we generally don't see. You generally don't see anybody leaving a president's council other than for personal reasons or something like that. All of a sudden, one CEO left, and then they all followed suit, and he basically ended the council and collapsed the organization. My take on the whole situation, when you look at Charlottesville and you look at what I just talked about on the President's Economic Council, I think there's more of that kind of stuff to come out of the White House and out of the disregard for the president or the office of the president and the president for that matter. And things like North Korea, I think we're starting to see them pile up one after the other after the other. And these are things that can ultimately and will ultimately, in my opinion, put a jolt into the market. And I think we will see the cycle take hold. It's taking time, and I get that. But here we are with a cycle top. We haven't closed above it, and it's options expiration week. And therefore, I'm going to give it some time, give it some space. Let's get through options expiration week. Let's let the clock run out, and then we'll see what happens next week. There is an interesting event that's taking place Monday evening, and that's a solar eclipse. So generally speaking, not every time, not 100% of the time, but solar eclipse can have and often do have an impact on the markets. So we'll see how that takes hold and what type of impact it does or can have. The last thing I'll mention on the market today, on the stock market for that matter, is we did have a release of the Federal Reserve minutes from last month's meeting. It became a non-event. They pulled some of their notes out of the file cabinet and just read off a canned statement. So no event. They're not planning anything. No surprises. And the markets like no surprises. Markets don't like surprises. So that became a non-event, and the market kind of whipped around just for a few minutes around midday. They released at about 2 o'clock Eastern Standard Time, and then we settled out, and the market basically went flat for the most part the rest of the day. The weaker index, even today, while it was flat, it was still certainly weaker than the spider, not by much, but it was weaker, remains to be the IWM. So the IWM is not a chart pattern that looks like a strong pattern to me. We're comfortably below the 138.74. We tested it yesterday. We're below that now. I believe that to be an important number for this market. And we're consolidating above the 200 period moving average. We can certainly go higher. I don't think they get above and close above the moving averages. That would be a tall order from where we are. That would be 2.5, or no, it would be 3 points from where we are in the IWM. And I think from where we are, that's a tall order. They may want to go fill the gap. They may want to touch the moving averages, but closing above those moving averages would be a tall order. I just don't think they have it in the cards. I don't think there's enough mustard in the jar for that. In my book, the IWM happens to be making a bearish pattern. You've seen me do this hundreds or dozens or thousands of times, okay? And generally, this will result in a secondary move to the downside. That's what I'm looking for, as long as everything else is correct in terms of the cycle and the timing of it. Real quick tonight, we're going to look at the VIX. And you see where the VIX was last week. It had a huge spike. Apparently, after the fact, I learned, or during the fact, I guess, that it was the largest amount of call options bought on the VXX, which is one of the exchange-traded products that I'm sure most of you are familiar with, that were bought on that product, the most call options, I believe, in history, and therefore, or at least the history of the VXX, and therefore, we saw that super spike up in the VIX, and there was a big buying frenzy in the VIX, and it stands to reason, after the fact, obviously, playing Monday morning quarterback, it stands to reason that we came all the way back down, and we're making a retracement of that move. And what was that move? So that move, I consider, from the low, okay, to the high, up here, all right, and if we draw out a fib retracement of that move, for example, it just so happens that a break of $11 runs into the moving averages. It fills a gap that exists right on that number, okay? So the closing price was, on this day of the 8th, was $10.96. I didn't do the fibs to the penny. Let me do that. I double checked. They happen to be on the penny. So 1 penny apart from the gap fill to the 75% retracement of that move and a gap fill and the moving averages. And this was a breakout area. This is where the VIX broke out way to the upside. They're coming back to retest that area, and it stands to reason that that area would provide a fair amount of support for the VIX. What I'm telling you is that if you're so inclined to buy the VIX and you want to play volatility, and that's one of the preferred ways that I like to play times like this is with the volatility index, then this would be an opportune area, an opportune time if we broke $11 in the VIX to begin buying the VIX at that level. It may happen tomorrow, it may happen Friday, it may happen Monday, but I believe it's going to happen in the next 2 or 3 days for sure. We really should go and touch those moving averages and pierce through the 75% retracement, filling that gap, and that, in my mind, would provide a pretty good level of support for the VIX. I think it's a good buying opportunity at that price. Before we move on, I want to tell you about a mistake I made, and it's a Monday morning quarterback mistake, but I think you all can take something away from what I didn't do the other day that I should have done looking back. I was not aware, because I don't watch the television during the day for the most part. Maybe 10% of the time I have CNBC on, 90% of the time it's on, but it's on mute. And what happened was I wasn't aware of the call buying activity in the VXX. Had I known at the time that it was reaching an all-time high or surpassed an all-time high, I would have taken that as a sign of a buying frenzy, panic buying, and likely the sign of a short-term top. As you know, I own VIX call options. I own them out to October, so I'm not really too concerned. However, had I known that the other day when the VIX spiked up over 17, I probably would have taken half the position off, completely prepared to put it back on at lower prices, but I should have booked some profit. I was up about 50% in one day in that call option, and I didn't take any profit. And what that is a shame on me. Now, here's the reason I didn't do it. Because I'm really playing for much higher prices. However, sometimes you really have to take profits when they hand you 50% return from your morning starting position in one day. It's almost against a religious belief not to take profit, or at least some profit, when things like that happen. So even though I've been doing this for a long time and I know that to be the case, I didn't take the profit, and I should have. And I look back, and even at this point in time, each and every day I try and learn something and take something away from the market. And I hope that you can take that mistake I made, and I don't think it's going to be a detrimental mistake. I think I'm going to be fine in the long run with the VIX call options. I think we're going to see higher prices than 17. That's not the point. The point is that I could have taken half the profit off the table, and I could have re-entered it tomorrow, Friday, or Monday, and I could have booked the profit. And in hindsight, I should have done it. It's easy to say now. It's hard to do at the time. I get that. I'm human like everybody else, and I make mistakes like everybody else. And rest assured, over my trading career, I have made every single mistake in the book. I have made every mistake that you've made, and most likely have made them more than once. And frankly, that's how I learned my lessons from the School of Hard Knocks on what to do and what not to do, but I still make mistakes like everybody else. And I chalk that non-sale in the VIX up to a mistake that I should have taken some profit. So hopefully you can take something away from that and learn something from my mistake and, not have it happen to you. When the market hands you a 50% return in one day in any instrument, any vehicle whatsoever, you have to book some profit. That's the way it works. All right, let's move on to the transports. And the transports were flat today, and you can see what happened. We did challenge the red candle high today. The red candle high comes in at 94.21 spot 26. Today's high was above that at 94.47 spot 61. We backed off and closed below it. It'll be interesting to see if the transports can close above that red candle high. That will be interesting because that'll most likely mean a close above the 50-period moving average. And that'll be a short-term positive on the bullish side for the transports. So I'm watching those very closely. Right now it's holding, but who knows what the next day or two brings. It's interesting. We talked about them testing the red candle high, and lo and behold today, they tested the red candle high and backed off. The likely scenario is that they'll trade in concert with the Spider, with the NASDAQ, with the other major markets, the Dow. The transports will likely trade for the next few days, at least 2 or 3 days, with the major markets. If they all turn down, they're all going to turn down. If they're up, meaning the Dow and the S&P and the NASDAQ, if they're all up, a rising tide will most likely lift all boats, including the transports, at least for the next couple of days. Also tonight, we're going to take a look at the broker-dealer index for a couple of reasons. Number one is it was down today, almost 0.5%. That in and of itself isn't that big of a deal. Mainly, I believe it was down because the bond market was up. When the bond market is up, that means interest rates are down. When interest rates are down, that means less profitability in concept and in reality. But, one day doesn't really make a market, doesn't make a financial or a balance sheet. But in concert with each other, the financials go down when interest rates go down, because what happens is they'll make less profit because they make a profit off the spread from what they can borrow money at and what they lend money to you and I at. And so therefore, when the interest rates go down, the rate in which you and I can borrow ends up going down. That puts pressure downward on the profitability of the financial institutions. However, from day to day, it really doesn't matter in the big scheme of things, but that's the concept of the inverse relationship between the bond market and the financials. More importantly, I'm looking at this bearish pattern, okay? And I'm looking at the broker-dealers in this bearish pattern, stuck underneath the 20-period moving average, but sandwiched in between that and the 50-period moving average. Likely this pattern takes us to the downside, but the 50-period moving average has thus far provided a level of support. However, now we're consolidating above the 50, and any kind of retest or any kind of sell into the 50 with any kind of momentum, and likely scenario is that the 50-period moving average won't hold and will trade lower. So this is a bearish pattern, and I'm watching this like a hawk, like all the other markets as well, because the financials are a tell of the major markets. And as we know, without the financials, the market's unlikely to go on the upside, and without the financials on the downside, the market's unlikely to sell off with any kind of magnitude. Gold was up today, and we talked about the fact that this could just be working its way higher. And if it worked its way higher, I would not necessarily be as willing to short 1,300 as I was 4 or 5 days ago. And that is the case. So if we continue higher, I'm going to wait and see what kind of pattern develops if we make a bullish consolidation. If we take a straight shot up to, for example, 1305, 1307, which would be double top, that may be a different story. But if we begin to creep our way higher and work our way higher, I'm going to have to look at some of the higher levels we discussed last night, namely 1320 to 25, and then 38 to 40 is the level. Right now, with only a 2-day pullback, I'm not sure how high gold can go out of a pattern like this. It's basically all it did was a 2-step down, and we're just riding higher. We'll see what happens over the next day or two. But if we continued higher, I have to believe we'll run into a fair amount of resistance at 1292 in that neighborhood. But we'll see what happens. There's nothing tradable in gold, in my opinion, right now. If we pushed higher, there may be a short trade, but on the long side, it's not for me right here, right now. It's just not a high enough probability trade on the long side. Let's take a look at silver. We had an interesting day in silver. Silver was up almost 2.5% today. Gold was not even close, up about 0.7%. And basically, we talked about that big down candle from yesterday into the moving averages, and today we basically reversed it. And we did it over here as well. We had the big down day, we put in a doji candle, pseudo doji, tail candle, whatever you want to call it, and the market traded higher. Yesterday, we came into the both moving averages, and today we reversed it. We never came into the trend line that we put on here last night, but we're headed up to the 200-period moving average. That should be a decent amount of resistance, but we've already been there, and we made an attempt at it again 3 days ago or 2 days ago. So if we did bust through the 200 period moving average, I still stand with 1740 as the next major area of resistance for the silver market. Again, same routine. I'm not willing to trade this on the long side, but there may be a trade coming on the short side. Have to wait and see how it gets there and what it does when and if it does get there. But right now, it's not a high enough probability trade to play it long. We've already been up too much to buy a market up here. But if we traded much higher, 1740 may provide an opportunity. Certainly at double top up here would provide a shorting opportunity as long as we got there in rapid pace. One thing I will bring up today, which there is a divergence going on here, and I want to make mention of it, which is the GDX. I haven't talked about it in a while, but I think it's worth a mention tonight. And the reason is because GDX, similar to silver, was up about 2.5% today, while the metal itself was only up about 0.7%. Now, that's generally a leading indicator of higher gold prices to come. It happens more often than not. GDX will lead on the downside and lead on the upside. And today, this was a pretty good move on the upside, and we'll see if they can bust through this downsloping trend line that I think would generally provide formidable resistance on the upside. However, with today's up day and a very strong move at that, above all the moving averages, approaching this top over here, let's see if we can bust through. The level we want to watch on a daily chart closing basis is 23.42. The top from this red candle is 23.42. It also happens to coincide with the downsloping trend line. It's funny how that works, doesn't it? So what I would say is if we closed any day above that level, that would be a bullish sign. A secondary close above that and we'll trade higher. If we get to that level and the market gets rejected, which it likely will on the first hit, and that would provide a scalping opportunity if anybody's interested. However, it's an intraday scalping opportunity. From a swing trading perspective, it's a tough trade to be short the GDX. That's all I have to say. But this downsloping trend line and that red candle high under normal conditions would provide a fair amount of resistance at that point. Looking at crude oil, yesterday we talked about the 47.10 area. We put in some kind of doji candle, but in the middle of ranges, we don't pay too much attention to those. And basically, it was just a reaction off the $47 area. And today we went back down and we're coming close to my target of 46.50. Could it go lower than my target? Of course it can. I just thought we would ultimately get to a minimum of 46.50. If we go lower, then there's lower prices coming, of course, and some of those lower numbers are around 45.40, 45.30 area, and then even $1 below that would be the next area of support beneath that. So if 46.50 does not hold on a daily chart closing basis, then you can expect at least 44.30 in that camp, and then all the way down, 45.30, and then all the way down to 44.30. You know, give or take. With crude oil, you have to always give or take 10, 20, 30 cents. I'm giving you ballpark numbers based on garden variety retracement areas. And just to point out a trend line I think is interesting, you know, I drew a rough trend line here, and obviously we pierced it here, but not here. Not here in this candle. We came into that trend line. We rested on it yesterday. We tried to recapture today and failed. So apparently this trend line, or at least the market, thinks this trend line is important, and it's interesting. So the next level will come down to be around this area, and then all the way down to 44.30, 44.25 in that neighborhood. And that may provide a buying opportunity down there, but we'll have to see how, when, and if it gets there first before making any kind of suggestion of a buyable opportunity. But I thought that trend line was interesting, at least to point out nonetheless. Looking over at the bond market, nothing really happened other than the fact that the bond market was up slightly today, but we're still in this bearish wedge pattern. We talk about it each and every day. I don't have any new information. The moving averages are holding, and that's fine. But until and unless we break above that trend line, then this market wants to go lower. It's just a matter of time. It's just a matter of when and how. So we'll move on to the dollar. And the dollar saw a sell-off today pretty much after the Fed announcement, I would say. I didn't take a close look at it, but I would imagine. No, it really started selling off around noontime or almost 1 o'clock. So that's interesting. So that was before the Fed announcement, the market sold off or the dollar sold off. So back to the daily chart. So all we really did was come back to retest the 20-period moving average. So that's kind of normal market behavior. We can go sideways like this above the 20-period moving average. Wouldn't necessarily be negative. We can go sideways like this for another few days, and that would be setting up for another push higher. And that's what I see. Unless we close back above, below, the 20-period moving average, then that would be a little bit of short-term trouble. But there is a gap here left from the other day, and they'll probably want to fill that gap real quick. But if we close below the 20-period moving average, that would be a short-term negative. If we just go sideways, in my mind, that would be bullish for the dollar and promote higher prices coming. And with that, I'm going to leave it there tonight. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.